just to give you guys a quick introduction of Alok. I know most of you already know him and are big followers of him, but uh, Alok started off as an engineer. He did his engineering from IIT Delhi and then did his MBA in finance from University of Maryland. He returned to India later on to start his journey in markets by setting up one of the first NSE memberships in Delhi back in '96. In the next 2 decades, Alok developed a keen sense for systematic rule based investing systems and technical trading. And after several years of hard work, he eventually launched Weekend Investing Analytics, which offers DIY portfolios through the Small Case platform. And speaking of Small Case, they were, fun fact, the first SEBI registered fund managers on the platform and serve over 15,000 users. So, Alok, thank you so much for tuning in and doing this Spaces session with us.
Thank you so much, Yash. It's a pleasure to be here on your Twitter Spaces. I think a lot of people are following the Twitter Spaces on your channel. Although I'm quite new to this, but I hope to have a fun time here.
Oh, absolutely. And we'd love to, have you back again, probably soon. So, just a small request from my side, just plugging it in here.
Sure.
Awesome. Alok, before we get into markets, I remember you doing an interview with CNBC about a year or 18 months back explaining about momentum investing. Can you, give us a refresh of it for all of our listeners who are tuning in right now as to what momentum investing basically is? What are the risks involved and what type of investors is this style most suitable for?
So just like, you have the conventional investing style where people really study the fundamentals or projections of the company or the economy or the sector to decide on whether the company is relatively cheap or expensive, to make sure that they are buying at the right time or selling at the right time. So the factor that they're using to invest is essentially valuation. So there are several such factors which are possible to follow in the investing world. And momentum is another such a factor where you are essentially following the price behavior of the stock to determine its relative position to the rest of the market. So, for instance, the whole concept of momentum, if you recall your physics lessons, is that a body in motion continues to remain in motion until an external force is applied to it. That is the ideal world case. And in the stock markets also, a similar phenomena takes place where a stock, once it starts to roll, whether higher or lower, it continues to roll till a point where it doesn't. So the whole thesis is around the fact that once you've identified that a stock is moving in a particular direction, the thesis is that you're assuming that it will continue to do so for some more time. So essentially, momentum investing thus becomes a study of the stock price changes over time. And once you create a portfolio of certain stocks which are moving together at a certain time, that's called a momentum portfolio. So just like value or fundamental investing, which can be done in 10,000 different ways, here also momentum investing is just a very generic term. You could design a momentum investing strategy which looks at very short-term movements. You could look at very long-term movements. You could look at absolute momentum within stocks, or you could look at relative momentum across stocks and sectors. So there is a variety of ways in which a momentum portfolio can be constructed, but the base theory being that the price change is what is what you're following. So essentially, if you've heard of the Gujarati saying "Bhao Bhagwan Che," so we call it the BBC principle, and we've been trying to apply that in our entire psychology. That we are not trying to forecast the market. We are not trying to front run the market. We are allowing the market to tell us which stocks are doing well, which stocks are not doing well. So stocks that are going up for us, like we only do long only momentum investing, although momentum investing can be done long and short as well. But for simplicity's sake, if we just look at momentum investing on the long side, then we are saying that, you're buying what goes up and you're selling what goes down. That's as simple as it gets.
Got it. And Alok, what type of investors is this style most suitable for? What are the risks involved over here?
So I think there is a large number of myths around momentum investing, and the name itself sort of lends itself to a suggestion that this is some sort of short-term trading, or this is not worth comparable to the conventional investing. But there's nothing like that. I mean, if I'm doing long-term momentum investing, I could be holding stocks for a year, 2 years, 6 months, so on and so forth. Of course, it is not. It cannot compete with the 5 or 10 year type of strategies out there. But in general, it is suitable for everybody. In fact, I would say momentum investing is much more peaceful than conventional investing because it limits your downside. Because you are always allowing your winners to run, you're cutting your losers early. So ideally, you should not be in deep pain at any point of time, even if the market goes bonkers on the downside.
All right, got it. So, Alok, switching gears, let's talk about market. It wouldn't be an overstatement to say, 2022 was a roller coaster ride for equity markets. Are we likely to see more of this in 2023, or are you optimistic about the future?
So let me just first qualify that we don't forecast the market. So my own personal sense of where the market goes really has no relevance to what work we do. The other fact is that out of the COVID bottom, which was 7,500 on the Nifty, we rallied for about 18 months post that, and we went from 7,500 to about 18,600 by about October 21. So in about 18, 19 months, we traversed about 10,000 Nifty points. And we had not traversed 10,000 Nifty points in its entire history till date, starting from 1995. So we covered a lot of ground in those 19 months that requires, a significant time for the market to digest those gains and for earnings to catch up to the lumpy returns that we got in those 2 years. So in most markets, especially when they are somewhere close to euphoria stage, you would notice that a lot of years of earnings get lumped and clubbed in a very short period of time. Like you would see this in any market. For instance, real estate market in India, 2004 to 2011, the next 10 years of inflation got baked in those 6 years. So markets often tend to move in lumpy fashions, and that's what we witnessed post-COVID for an 18-month period that we had. And now I think it is a period of consolidation for the Indian market, because Indian market inherently remains very, very strong, and that is confirmed by the fact that we are 4-5% from all-time highs, whereas other markets are 4-5% from their 52-week lows. So the relative strength that the market has displayed is tremendous, and this is in face of huge FII selling in the last year and a year and a half. So from the perspective of what the market is trying to tell you, if you listen to the market is saying that I'm just waiting for the global headwinds to clear before I move further up. So from that perspective, whether it takes 6 months, whether it takes 12 months for the the global cycle to play, and nobody really can call that. I mean, there are people who are calling first half to be tough, but the next half to be really good. And then there are others who are saying that, because everybody is calling it a recession, it ain't coming. So this is actually the beauty of the non-discretionary systems that we run in Momentum, is that we really don't care who's saying what or what are we feeling about the market. I mean, that is not a part of the deal at all. So from that perspective, I think Indian markets are quite reasonably poised. Even from a traditional price earnings based perspective, the forward earnings which had run into late 30s is now I think down below 25, which is very near to the long-term, average of maybe 18 to 22 on the market. So, give or take 5 or 10%, and I don't think there is much of downside left. But that's just a personal sort of, speculation. I could say that, from my thought process. But the market is not giving any signal for any downtrend anytime soon. Yeah, I mean, we are at 17,900. We could come to maybe 17,400 or 17,300, but I don't see much more fall than that in the immediate case.
Got it. Alok, I did wanted to ask you that, a lot of the experts are, forecasting first 6 months of the years to first 6 months of 2023 to be difficult. In that case, would it be a good time to diversify beyond equity, and do you like gold or silver, maybe even debt, considering the rising interest rate scenario?
Asset allocation is something that you must do regardless of market conditions, because if you take the track record of all experts put together, 80% people do not beat the markets, and 80% people do not come out with the right forecast. So it's maybe better to flip a coin and choose your direction rather than listen to anybody else. But having said that, uh, asset allocation is a extremely important step in your creation of your financial portfolio. Of course, depending upon your age and depending upon your goals and situations, it may be very different for each individual. And of course, the financial advisor can give proper legal advice on this. But in general, I would say the kind of environment that we are in, real assets such as real estate, gold, I think they'll play a very big role. And if you've seen already in the last couple of years, a lot of pro equity people have been bashing gold, have been bashing real estate, because traditionally Indians have been investing there. But they're having the last laugh. I mean, just look at where gold has gone in the last 3 years. Just look at where micro markets in real estate have gone in the last couple of years, especially in NCR region from where I belong. So all asset classes need to be, there in your portfolio. Of course, if you are very young, you can gradually enter into each of them. But over a period of time, there will not be one asset class which should be rolling your entire portfolio. I mean, equities. I mean, I see a lot of people saying, we want 100% in equity and stuff like that. But when your portfolio size becomes very large and your heart is not as strong as when you were at 25 years of age, I mean, 100% into equity doesn't work. So everything is not just returns. There are things beyond returns that a portfolio has to provide.
Got it. But Alok, I completely agree with you that the most personal thing in this world is personal finance. And while one size fits all approach might not be ideal, but hypothetically, if you were to say, build your financial plan right now, what would be your allocation towards equity, within equity, what large cap, mid cap, small cap, and other asset classes like commodities and debt?
So, I mean, for hypothetical case, if I were to look at a 50-year-old person, I would say put 1/3 each into real estate, gold, and equity. That would be my sort of go-to recommendation, because the kind of monetary experiment that we are seeing across the world, uh, there will be a phase of transition that will have to come through when the US dollar hegemony finally gets broken, and hopefully this decade will see that. So gold is actually going to play a very, very crucial role, and just more to it, just add more to that. I mean, one should always question, because a lot of people are questioning, why gold. One should question why central banks are accumulating gold. Every central bank of worth their salt are accumulating gold every month, virtually, and especially the ones who are having weaker currencies. So the point that is missed by most portfolios is that all our assets are denominated in a INR currency, right? I mean, we may be sitting on real estate, we are sitting in equity, we have bonds, we have money in the bank, whatever it may be. It's all Indian rupee denominated. Now, we are fortunate that we are sitting in an environment where we have a stable government, we have a stable economy, we have a stable currency, not more or less. But what happens if that changes? I mean, what have people done in Turkey? What have people done in Japan? what have people done in Egypt recently? The people who had exposure to gold and a good exposure to gold have been able to preserve their their buying power, because the local assets in the local currencies get demolished when the economy goes for a downtrend. Of course, we are very fortunate that we are sitting in India and we have such a robust economy going on with us. And for the next decade or two, I don't see any problems. But from the perspective of a hedge, if you look at the last 30 years of the correlation between Nifty and gold prices in India, you will find a perfect contra correlation. Where in years where Nifty did not do well, Indian gold in Indian rupees did very well, and years where Nifty did very well, gold may not have performed. So overall, if gold has given 11.6% over the last 5 decades of CAGR, and Nifty has given maybe like 12% or something like that over the last 2 or 3 decades, I don't see much of a difference in the two asset classes in terms of the overall returns. In fact, the volatility on gold is much lower than Nifty. So,
Yes.
Essentially, to come back to the balancing point, is that we must not rubbish any asset class, because each asset class has its advantage and it gives you that uncorrelated return that is required in your portfolio. So make allocation to equity, make allocation within equity, of course, to large cap, mid cap, small caps, and maybe even alternative strategies in futures and options and things of that kind. And of course, outside equity, also look at gold. Also outside equity, look at real estate. Outside equity, look at fixed income as well. And I think you need not really worry once you have a very balanced portfolio.
Got it. Alok, let's move the conversation towards specific sectors. And I'd like to ask you about private banks. Do you think they can do what Virat Kohli did yesterday? And the reason I ask you this is, while the banking and financial space has done fairly well, it is actually the PSU banks that have massively outperformed in the last year. So will 2023 be the year for private banks?
So private banking has been doing extremely well since long, actually, and PSU banks are just beginning to catch up. I mean, if you look, like 5-10 years of growth in private banking, I mean, private banking index has gone up like 10 times in the last 10 years, whereas PSU banking index has probably not even doubled since then. So there is a lot of catch up that is happening, and it does seem that there is some sort of a shift that is happening, where some money, because private banking has become extremely expensive as we have gone from year to year, and although on the index front, private banking index hasn't really come off. It is just that it has not gone up just like PSU banking has in the last 6 months. So I don't think there is anything stopping private banks right now, but it is just that the pace at which, because the PSU banks were so badly beaten up that 50% or 100% gain on those stocks have just brought them at par with where they were in 2018, for instance. So I still think PSU banking index is far from really coming out as a high momentum play. Although right now in many of our strategies we have PSU banks in the forefront, but private banking has been doing quite steadily well. I mean, the results of private banks have been quite good, and I don't see a reason why they will not continue to do well. But I don't think there is a point where private banking will really take off and PSU banks may lag. I don't think that scenario is happening anytime soon.
Got it. Alok, I know purely from a momentum perspective, IT stocks are looking weak, but do you think that they could make a comeback in 2023, or you'll just stay away from them?
So, IT stocks are very interesting, because I was just looking at IT stocks today and we did a video on it. IT stocks from the COVID bottom, the CNX IT index, that was somewhere near, let me just open up my chart here.
Yep.
So COVID bottom was somewhere around 11,000 on the CNX IT. And from 11,000 odd, within the next 18 months or 20 months, it went to nearly 40,000. So
Wow.
almost 3.5 times was the IT index. You can imagine what happened to some of these stocks.
Yeah.
So from having gone from 11,000 to 39,000, it has now corrected to about 28,000. So about a 30% correction after a jump of 3.5x. I mean, that is par for the course actually. And with the kind of fall we've seen in NASDAQ stocks and which tend to lead the CNX IT index, I think NASDAQ has come off dramatically from where it was and is now looking to stabilize somewhere. So maybe, another 3 to 6 months, NASDAQ may stabilize. And once that happens, then I think the IT stocks will have a good time. But right now, I mean, of course, none of our strategies are into IT stocks because I mean, we will board them once they ask us to board them. But right now it could be a value because zone, but that part of the equation is sort of alien to me. So I would not go ahead and say that one should pick IT stocks. But once you see that stocks have bottomed, there's a technical bottom that is being formed there, and maybe even the fundamentals are starting to show that there are green shoots on the other side. I think that will be the time when you could start looking at IT. And I always believe that instead of trying to pick the bottom, you allow the first 10-15% to go away. I mean, if you're going to pick a stock at 100 rupees and sell it at 300, how does it matter if you pick it at 100 or 120? So allow the stock to tell you that it is ripe to go up, and then you buy it, and that probably is a better strategy.
Yeah, got it. Alok, before I hand it over to Kshitij, one last question, not market specific, but on the whole retail investing landscape. We've seen that in the last couple of years, there's been massive retail participation. We've just from our retail base itself, we've been able to handle the FPI outflows. How do you see this landscape evolve over the next 5 years?
I think from my limited knowledge about the retail account opening, I mean the numbers that I read about almost 10 crore demat accounts have come up overall, which were pre-COVID approximately 2.5 or 3 crores. So the market has quadrupled within the last few years. So just like the IT index that you were talking about, once a asset class or an index has quadrupled, you would should not be surprised by some cool off after that. So my sense is that we are consolidating since October 21. So retail pace of retail growth of people coming in definitely has slowed down. Uh, so now the folks who had come in, whether they will stick around or whether they will run away from the markets, that will determine how many of these demat accounts stay active. But I think in every market there comes a pivotal point where the pace at which we were getting new users in the market in the last couple of decades, that seems to taken a different flight path since COVID. And of course, as we continue to do well in the economy, I think more and more people would be coming into the markets to invest. And the only thing is that whether our interest rates will stay elevated or not. I mean, because that is something that starts to become very attractive from a returns perspective. Once the 8.5-9% kind of returns are possible in the bank, then there is sort of a friction in terms of coming to the market. So as long as we stay within the below the 8% kind of interest rate mark in terms of returns in your bank FDs, I think a reasonable amount of flow to the markets is possible. And also the demographic change that is happening, the number of youngsters that are coming into the workforce, and the kind of exposure the young generation has today. I mean, I'm shocked when I interact with thousands of people on Twitter, the kind of knowledge young people have these days, at 23, 25 years of age. So they are doing a fantastic job in terms of educating themselves, towards financial products and financial literacies. They're going through the roof with a lot of education and those kind of portals going around. So I'm pretty optimistic about reasonable growth on this front going forward. So because the kind of lull that we have seen in the last year and a half in the markets, I don't think I had seen SIPs and all those other parameters stay stable during such lulls in the past. But this time around, even with the lull, the domestic liquidity flows have stuck around. So there does seem to be a different flight path.
Yep, and these are really very interesting times. Actually, in fact, while Alok, you were talking, I tried pulling up a data point, and since from December to December 20, we had about 5 crore demat accounts, and that number is now at 10.8 crores. So we have more than doubled in a 2 year span.
Yeah.
On that bullish note, Kshitij, over to you.
Thanks, Yash, and good evening, Alok. Well, I'll keep I'll keep my session short because I'm slightly under the weather. But these are interesting times, as Yash and you've already highlighted, and I'll take it off from where Yash left off. Now, definitely the retail investor trend could actually plateau, and this is something which in fact Zerodha in one of its blogs also highlighted, that we've seen quite a bit of strong surge that we have seen post the COVID. But what do you make of the huge SIPs sort of coming into mutual funds? And this is, I think, the third time when 13,000 crores sort of inflows came in towards equity markets. Now, this is a lot which has to unfold for Indian equity markets as well. So, what are your views, and do you think the new breed of investors have actually changed, from what we know in the past?
So I think carrying on from the last point with Yash, I think, and also the Zerodha narratives. I think Nitin plays a very clever game in giving very low expectations for the year ahead, but then he comes out with a 2,000 crore profit at the end.
Yeah.
So he's a great. He's probably the right person to give you the perspective on the retail. But I've not seen much of a degrowth in their numbers yet, even at the March 22 numbers. So from that perspective, and from the perspective of the fact that just financial literacy in general is increasing exponentially. I mean, if someone who has joined anywhere in a job and is 1 year in, I mean, he's asking about, where should I be investing my savings? Where should I be doing this? So this entire generational change seems to have happened in these last few years, where people are more aware, and and the options that are available to them have exploded in terms of financial products as well, and of course many more to come. We're just scratching the surface in terms of ETFs or other kinds of fund structures. So maybe we've just sort of scratched the surface right now, and exciting times to come, I think.
Right. Exciting times to come, and I think the way you highlighted about how Nitin works. I think sometime back Infosys used to follow the similar strategy.
Yes.
Under promise and over deliver, I guess.
Yes.
Right. Now, let me also ask you. So how should one be playing the small and mid cap theme in 2023? Although the broader markets were slightly, underperform the benchmark indices. So what are your views on that particular space?
So my sense in general towards the market is that don't try to time the market. That is my sort of base case for any exposure to the market, that you should allocate to the market but not try to time the market. So if you are saying I'm going to allocate 40% to the equity markets, And within 40% allocation to equity markets, I'll allocate 10% to large cap, I'll allocate 10% to mid caps, 20% to small, whatever may be that become. I think the allocation is what is important. Beyond that, to deep dive into each stock or each quarterly result, that is actually the business of a professional doing that. A lot of people tend to not take professional advice or follow any fund manager or a small case, something like that. But what I've seen is 90% of retail investors do not have the time, do not have the research capabilities, do not have that passion to get under the skin of that company and its vendors and the 10,000 different variables that are working in that company to really make a very good case for buying as well as selling. Everybody is able to buy, but very few people are able to sell at the right time. So my sense is that you should find vehicles which will give you the flavor of that particular segment over a period of time. Let's say a small cap fund or a small case or a small or some ETF of a large cap this thing. You allocate to that, but don't try to time it, because to say that I'll be able to buy small caps when they're cheap and sell it when they're high is very, very difficult to do for a average retailer. Of course, there are many experts out there, but most people are not able to do that timing because they are busy with their own professions. I mean, you have to excel in your own profession and let the other people who are excelling in this profession handle those decisions for you. So allocation is something that your financial advisor should get right for you based on your age, goals, situation, so on and so forth. Other than that, uh, the particular segment returns will not be so far off. So one manager may have 30% return in a particular small cap. The other may have 40, some other may have 25. It won't vary over so much over a 10-year period that it will make a huge difference of any sort. So allocation is very, very important. Asset allocation first, and then of course within equity, different allocations are very important.
Right. In fact, I completely take your point on that. And, in one of your tweets, you did touch upon the mental fitness, which is quite close to my heart as well, because we also run a, weekly series which goes by the name of Mind Over Money. And so just, focusing on that topic, and for viewers who are listening in at this, on this Twitter spaces. So why is a relaxed mind essential for trading?
So I think that is the key for a good trader to come dispassionately to your trade,
Mhm.
not have any emotion towards it. I mean, it has to work like in a military-like fashion, machine-like fashion, where you're coming to the trade, you know what position size it is, you have to take, where you have to take profits, where you have to take losses. It is like a very mechanical process. I mean, I see most people getting so involved in a trade and they get very happy if it is moving their way, they get very sad if it's moving against them. But that is not how you will become a great trader. A great trader never has any emotion towards the trade he's doing. Yes, at the end of the year, what he needs to analyze is that, okay, I've done 100 trades this year, 40 trades went right, 60 trades went wrong. But in the 40 trades that I did, I made 3x each time. And in the 60 trades that I lost 10% each time. That is fine. Overall, I made a lot of money. And I stuck to my strategy. And that is what the real trader evaluates, that how disciplined have you been in sticking with your strategy, and the result is a byproduct. The profits that you're making are a byproduct of your being good at trading. So the idea is not to look at the money, but to look at the process and the discipline. And once you have that right, I think money will just follow you like anything. So coming back to the mental models side of it. uh, so come to this sort of Zen-like situation where you are not getting worried if you are holding a position, because if you're going with a process, and you know that over thousands of iterations, you know that 50% of my trades will go wrong, then you will not worry about it. I mean, so this discretionary way of ad hoc way of doing trading, that you like something someday, somebody has told you to buy this, somebody has told you to short that, that is all nonsense actually. I mean, money can never be made in that. You have to define your process, and there are 10,000 ways of doing it. There's no one way of doing it. You have to define a process, you have to define your position sizing, you have to define your risk management, you have to fix how you're going to trade, which instruments you're going to trade, what time frame you're going to trade. You have to, of course, do a lot of study and back tests on those strategies, then do it in real time. So it is a very a factory like situation where you're going from one step to the other to the other to the other with no emotions involved at any point of time. So whenever you come to this factory of yours with a disturbed mind, what will happen is that you will skip a step. You will get fidgety with some losses even before they hit your stop loss. You will try to move your stops. You will try to take early profits. You will deviate from your initial plan. So it is a disturbed mind cannot do trading. I usually say, if your mind is disturbed, don't trade that day, or at least don't trade until you are at peace, at calm with yourself, because it will really screw your account really badly. So that, I mean, the peaceful mind part of it is absolutely the foundation of doing things right, and if that is not there, nothing can work really.
Well said, Alok. In fact, I hope whosoever is listening to this Twitter Spaces, they do make a note of that. That a peaceful mind and a Zen mode is something which will help you become a better and efficient trader. Now, Alok, if you can touch upon the various techniques, how one can do that. Yes, it is easier said than done. We can all think that we can behave in one way or the other, but which other means? Is yoga is one thing, or meditation? What do you practice?
So I think there are several things that one needs to do here.
Mhm.
One is, of course, to imbibe sort of a restfulness or peacefulness within yourself, and that is something that comes over time. I mean, you can't really change your nature overnight
Mhm.
of being excited about things, or not having that sort of a longer view of things. That this trade that I'm doing is one out of the 1,000 trades that I will take this year. So it by itself, it has no significance actually.
Mhm.
So to have that understanding that I'm doing a business where I will do 1,000 trades this year, and this is one trade out of those 1,000. So it really does not matter if I make 2% or I lose 2%. I just have to follow the process.
Mhm.
So that kind of a sort of a bird's eye view of what you're doing yourself is actually standing back, and you're kind of seeing that, okay, this is what Alok Jain is doing, and I have to make sure that he follows the process. Uh, and of course, meditation. I mean, I go for long walks and things of that kind to do that, but I don't really trade anymore. I used to trade when I was young. So over time, you will also see that trading uh, larger amounts, as as you accumulate wealth, becomes more
Mhm.
and more difficult, and scaling becomes difficult.
Right.
Because the instrument that you may, you know, maybe you are trading a 5-minute option strategy that can, trade maybe a crore of rupees, but tomorrow if you have 10 crores, the same strategy may not work. So scalability of trade. I mean, why don't FIIs all do options trading in 5-minute time frame and forget about investing if everybody can make 100% returns every year? So this is the reason that for each time frequency there is only a certain amount of capital that can run, and once you cross that capital, you have to go to slower returns, which are available. So coming back to the main point is that uh, you start small. So the most common mistakes that people do is that they are beginning to start trading. So first of all, you've not decided over a period of time how you're going to trade. So that will come over a period of time. This is my strategy. This is how I'm going to follow it. You've not practiced it. You've not backtested it. You've not paper traded it. You've not started with 1/10 of your capital and seen that how will my month go, because you are in a hurry to make money the next day and double money the next day. So if you have 100 rupees as capital, you start with 10 rupees. You let it go for the next 1 month and see what happens. If you and making journaling and documenting your trade as well as your mental makeup is very important. I remember when I was younger and I used to do a lot of trading, I used to maintain a journal where I used to write after 3:30 every day that these are the 5 trades that I did. This is the reason why I did them. These are the mistakes that I made today. And every few days or weeks, you could sit and analyze that. This last week I made, and I must improve it the next time onwards. So gradually, get better and better control over the mistakes that you're making. And biggest mistake that most people make is to jump from strategy to strategy every other day. 5 days my strategy is working, then the next 3 days if it doesn't work, so let's jump this strategy and start a new one. There are 10,000 videos on YouTube every day how to make money. You just find one way and stick with it for the rest of your life, and you'll make enough money. That much I can tell you. But you need to stick to something. I mean, if you jump from one to the other to the next every other day, this is not the way the big traders make money over their lifetimes. So having this, sort of what should I call it? The Hindi that word is that
Therav, right.
Is very important, and of course the young traders will take time to get there, but I think this hurry to come to profits, to double your money, quadruple your money should not be there. The hurry should be there to come very close to perfect execution of your disciplined style of investing or trading. That should be the base that you're working on, and money will follow you. But a lot of people don't believe that. They want to see the money tomorrow. To that is their confirmation bias that yes, I'm doing well. But if you're doing the process well, the money will come. That much I can say.
All right. In fact, golden words there, Alok. If you're following the process, that's what will matters, and the money will eventually follow. So if someone is really making a note of this Twitter basis, I think this is one of the golden lines which has really come about. Now, finally, what do you make of the global recession fears for 23? Do you see it impacting our exports, and where can investors find comfort in this market?
My sense is that, as I mentioned earlier, that the markets are not displaying any sense of weakness as of now. We are 5% from all-time highs. I mean, to me, that is very, very bullish actually. Yes, we are taking time in consolidating and digesting the gains of the last few years. The earnings of the top companies are catching up. So Nifty is nowhere as highly priced as it was a year and a half back, and maybe there is more time to go in terms of some consolidation. In terms of the growth aspect, nobody is denying as of today that will not grow 6 to 7% in the coming years. That may make us one of the fastest large growing markets of the world. There is a definite movement of supply chains from China. Even if businesses in US and Europe are not moving from China, they want alternates, and India is definitely getting that business over the next few years. So there is no macro situation right now where we could really get a beating out of this, unless the world itself collapses on itself in some 2008 kind of fashion, where of course then we go for a dip for a few months. But overall, I think if I were to guess, we will not get hit even in that situation very hard, because if you just take 2 steps back, in these 2 years, a lot of new money came in to the market. New 5 crore, 7 crore new accounts. All this money has never seen a recession, has never seen a market dip. And the volatility or the lull that we saw in the last 1 year, a lot of this money would have run away from the market. Was it not, reasonably mature by now? So people have, consolidated. People have digested their gains. They are willing to take more risk, and I don't think liquidity is going away anytime soon. And we found very good counterbalance to the FII liquidity, and the FII percentage holding in Indian stocks is coming very near to their historic lows. I'm forgetting the figure that I read. I think it is somewhere close to 14 to 16%, and it used to be 20% plus. And the lowest it has gone is, I think, somewhere close to 12 to 14%. So we are very near that situation where the FII holding in India may just bottom out, and there may be 2 years of run on emerging markets that may come. And that is another angle where the dollar seems to be peaking out, and as the US dollar comes down, there will be a lot of flows towards the emerging markets, and emerging market funds will have to allocate towards India more and more. So if that flow starts to come along with the domestic flow already being there, I mean, we could rocket like anything. And the same situation may happen that just in a very short phase of year or 2 years, we may discount the next 6 years. That may happen. So trying to time the market is going to be very difficult. You need to stay in the market. You need to stay allocated. And of course, you'll have to believe in the India story if you are going to, be in this market.
Right. Now, believe in India story. Yes, that is the takeaway from that. Over to you, Yash.
Alok, we've got a couple of questions from our listeners. So Sojir Sheshagiri wants to know, should investors do an SIP or one-time buy, and what are the pros and cons of it?
Yeah, so good question. When you do a lump sum buy, there is always the risk that the market may go for a toss in the next 3 months. That situation can happen anytime, in any market. So that situation kind of becomes a bit precarious. You got 100 rupees, you put in 100 rupees, now suddenly they're 50. So, that can put you off the markets in a big way. But having said that, with the markets having consolidated for a year and a half in this range, I think significant lump sums can now be put in. I would still not advocate that you put in all your money in one go. You maybe make 3 or 4 installments out of it, and invest it over a couple of months, 6 months, 12 months, depending upon how you see the money flowing to you. But in general, of course, the SIP is very, very sort of I would say a preferred way of doing this, because then it takes your mind off of timing. I mean, as soon as you bring lump sums and installments into the picture, you're always trying to time the market. And at least I can say neither am I nor 99% other people in the market are good timers of the market. So I always believe in gradually bringing in the funds. And in fact, I'm running a public experiment of a SIP since October 21. So when the market actually peaked, I started a SIP in a strategy on in a CNX 200 stocks, and I said, let me show you what is the power of a SIP. And I've been running that now for almost 14 or 15 months, and we have 22% XIR in that strategy. So having a SIP in this kind of a environment where you are able to get the dips every other week, every other month, is also very, very beneficial. So to sort of culminate the answer, I think given the fact that 15 months of consolidation has happened, some lumps may be brought in, but in general, I would advocate about SIP only.
I'll do you one better, Alok. I think I had read somewhere that even if you were the worst possible timer of markets and you started doing an SIP at the top of 2018 global financial crisis, you would have got about 12 or 14% annualized return.
We did a video on this where we assumed that what if you bought Nifty on 2008 January 1st, which was the peak of Nifty in 2008. and where you reached in 5 years or 10 years. And the listeners can go to my video channel and try to find that. But it basically just showed that, it doesn't matter where you start. So a lot of people keep coming to me and asking, should we start in the market? When should we start? I say, don't wait. Just start today. You should have started yesterday, but okay, start today now. Because it won't matter when you're going to do SIPs for the next 10, 20 years of your life. How does it matter where you're starting right now?
True. Alo, again, I'm slightly going back towards our conversation and one question on the sectoral side. And this is because obviously autos have been immensely trending, and even the auto expo is going on. Yesterday Tata Motors was a trending stock on StockTwits as well. Obviously there was news based on it, and we saw a big 6% move. How do you look at the auto space? Can it continue to outperform in 2023 as well? Because like earlier in this conversation you were saying that domestic consumption and domestic focused theme will be a positive, and autos could be one of that sector perhaps.
Yeah, so I think autos have done really well since the COVID bottom. The auto index on the CNX auto index had reached a bottom of 4,500 in March 2020, and it is now at 12,750. So almost 3x is what it has gained from that bottom. But very interestingly, in 2018, it also peaked at 12,000. So from 2018 till now, which is about 5 years, it has gained just about 5% from that top. So from the perspective of where the valuations were at the 2018 top, and we've just gained 5%, and 5 years of earnings have had a chance to catch up. So we are nowhere near the kind of valuations we have seen earlier in the auto stocks. So from that perspective itself, and with the consumption story and everything, I think autos are very well placed. If you look at the auto index, we are maybe 5% away from an all-time high. And then just to give your viewers a context of all-time high, a lot of people are have this framework in mind that if something is at all-time high, then it is not good. It has already peaked or something like that. But from my perspective, looking at it from a momentum perspective, and all something that is an all-time high, any index, any stock, anything which is at an all-time high is actually telling you that I am about to go even higher, and that I've crossed all the resistances. There is no resistance above me. I'm a free bird. It may or may not happen. That's a different case, But the probability of a stock that is at all-time high going higher is much, much higher than a probability of a stock which is, let's say 50% from its all-time high. So one should, give up this thought process that a stock that is at an all-time high or a 52-week high is going to get weak. It is actually telling you the reverse. It is telling you that I am the strongest right now, and I may get stronger. How do stocks become multi-baggers? A stock at 100 rupees, when it goes to 200 rupees, that maybe it's 52-week high, right? And most people will get out at that point. 52-week high aa gaya, let's get out. And what does the stock do? A multi-bagger, it goes from 200 to 1000. So what is the basic trait of a multi-bagger? That it first needs to cross its 52-week high and then go multi-fold above it. Right. So if you are going to sell out all your stocks when it comes to 52-week high, you will never get a multi-bagger in your life. So you have to allow your winners to run, and you have to cut short your losers when you get a loser. So this is the only way big money can be made and peaceful money can be made. And momentum investing does this exactly. I mean, we don't allow any stock that is losing to stay in the portfolio for too long, and a stock that is winning, we will not touch it, even if it goes 10 folds, 20 folds. I mean, we made so much gains in Adani stocks, in Tata Elxsi, so many stocks
Yes.
kept running up and up and up. Once a stock is running, once your jockey is doing well, why would you want to stop it? You would want it to go as far as it can. And once this stock will give you a signal itself that no, I don't want to run any longer, I'm willing to fall now, you can get out at that time. So give up 10%, 20% from the top. What is the problem? So my sense is that most people don't even think of the markets in this way, because the over-encompassing pressure is that to try to predict, try to front run, try to find some nuance in the story which fits your study that you've done. Everybody knows everything about the stock, so never be under this consideration that you know something very special about the stock and hence it is going to become a multi-bagger, because the entire market knows about that stock and the price already knows it and has discounted it in the market for it. So the price is the first point of your connect, where the price has already discounted what you may think you already know. And that is why you will see stocks run up before they get good results, because the market already knows about it, or they may crash before they announce bad results, because the market already knows about it. And when you're looking at quarterly results, for instance, that is a snapshot of the last 3 months, right? I mean, if a company is coming out with a result of October, November, December and gives it to you on 28th of January, that information is actually 4 months old, starting from October, November, December. And we are trying in our own mind to extrapolate that information, that yes, the company has done like this in the previous 3 months, and hence it will do the same in the next 3 months. That is our own figment of imagination. So, but the price may be still a different story. You may see 100% gain in the quarterly result last quarter, but the price is coming down. That itself is a divergence that should strike you that something wrong is happening, something bad is happening in this company, and I don't even know about it. And of course, you will come to know about it once the price has come down 40-50%. Then most investors will come to know, oh, this is what has gone wrong in the company, or this is something there is bad results are about to come, or the scenario in that particular sector has changed. So most people will not be able to sell, because the information that is required to sell a stock comes to them very, very late, after the damage is already done, and hence people keep holding on to losers and damaging their portfolio.
Like they say, price moves first and fundamentals follow thereafter.
Absolutely.
Got it. Alok, thank you so much for this really engaging, really very candid session. I hope all those who tuned in had some or the other takeaway from this conversation. In